Hello everyone, and welcome back to video number 7 in chapter 12. And when we left off, we were looking at recording premiums redeemed and the cash associated with that. Okay, now the liability for premiums at year end, we're going to record that by debiting the premium expense here for $3,000 and crediting premium liability for $3,000. And we compute that by taking the number of vacation packages sold, which was 3,000. We estimated that 60% were going to be redeemed. So that was an estimate of 1,800 redemptions. And then the cost of that redemption was $1,800 times the $4 less the dollar that we would get back from the customer that redeemed it. So that's $5,400. And then we have had redemptions to date of $2,400. So that difference then is $3,000. Now, how do we record a liability loss? Well, this liability is presumed to be a loss of $250,000 here. A loss and a liability have been recorded because, one, the information that is available prior to the issuance of the financial statements indicates that it is probable that a liability has been incurred at the date of the financial statements. And number two, the amount is reasonably estimatable. The $60,000 legal case should not be recorded because that loss was unlikely to occur. It was a remote likelihood. Okay, so there's no gain for the, there's no gain entry for this gain contingency. While preferred travel has a gain contingency because the amount of cash to be received is not yet known. Any possible gain related to the lawsuit should not be recorded in the financial statements. This is because the company should not recognize revenue before it is realizable or realized. This contingency should be disclosed in the notes to the financial statements. Therefore, preferred travel should disclose that it is involved in a lawsuit and that the outcome is expected to be favorable. Okay, now we'll move on to indicating how to present and analyze liabilities and contingencies. Here, our current liabilities should be usually reported at their full maturity value. Two, here the difference between present value and the maturity value is considered immaterial. Number three, the companies may list the accounts in order of maturity, descending order of amounts, or order of liquidation preference. All right, here's Best Buy current liabilities as of February 1, 2020. And as you can see, it presents the total current assets and then the current liabilities, several items here, accounts payable, unredeemed gift card liabilities, deferred revenue, accrued compensation and related expenses, accrued liabilities, current portion of operating lease liabilities, and lastly, the current portion of long-term debt, all summed up to reflect here $8,060 of current liabilities. Short-term obligations expected to be refinanced. If a company excludes a short-term obligation from current liabilities because of refinancing, it should include the following in the notes to the financial statements. Number one, a general description of the financing agreement. Number two, the terms of any new obligation incurred or to be incurred. And three, the terms of any equity security issued or to be issued. Let's take a look at an illustration of that. Marquardt Company pays off debt of $40,000 on January 17th, 2026. On February 17, 2026, Marquardt issues long-term debt of $100,000. Marquardt's financial statements, dated December 31, 2025, are to be issued March 1, 2026. Should Marquardt exclude the $40,000 short-term debt from current liabilities in the 2025 balance sheet? Marquardt should not exclude this debt from current liabilities, and here's why. Repayment of short-term obligation required the use of existing current assets before the company obtained funds through long-term financing. And if we take a look at that timeline, the liability of $40,000 here as of the balance sheet date, then January 17th is when we paid off the $40,000. February 3rd, we issued the long-term debt of $100,000. And finally, on March 1, 2026, the liability of $40,000 was classified as current. Therefore, unlike the Motivon refinancing, through the issuance of stock, Marquardt has neither an actual refinancing nor a refinancing agreement in place to pay the debt on a long-term basis. As a result, Marquardt must include the short-term obligations in current liabilities at the balance sheet date. Okay, let's take a look at some ratios here. Two ratios help assess liquidity based on the information for Best Buy Company previously provided. So our current ratio, that's an easy one. We'll take our current assets divided by our current liabilities, and it gives me 1.1 times. The asset test ratio, here we're only can consider in the current assets cash, short-term investments, and accounts receivable net, meaning after the allowance for doubtful accounts has been subtracted, comes out 3,516 over the same current liabilities as was in the current ratio, and we get 0.44 times. You may remember that the rough rule of thumb for acid test or acid test ratio is 1 times. So the acid test or quick ratio, as it's sometimes called. All right, now we'll take a look at comparing the accounting procedures for current liabilities and contingencies under GAAP and IFRS. All right, we have some similarities here, as we always seem to. Similar to the U.S. practice, IFRS requires companies present current and non-current liabilities on the face of the statement of the financial position. U.S. would call that the balance sheet, with current liabilities generally presented in order of liquidity. However, many companies using IFRS present non-current liabilities before current liabilities on the statement of financial position. Under 2 here, the basic definition of a liability under GAAP and IFRS is very similar. In a more technical way, liabilities are defined by the IASB as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Quite an academic statement there. Anyway, liabilities may be legally enforceable via a contract or law, but need not be. That is, they can arise due to normal business practices or customs. Other similarities: the IFRS requires the companies classify liabilities as current or non-current on the face of the statement of financial position, the GAAP balance sheet, except in industries where a presentation based on liquidity would be considered to provide more useful information, such as with financial institutions. And then under IFRS, short-term obligations expected to be refinanced can be classified as non-current if the refinancing is completed by the financial statement date. GAAP now also uses the balance sheet date. There are differences. Under the IFRS, the measurement of a provision related to a contingency is based on the best estimate of the expenditure required to settle the obligation. If a range of estimates is predicted and no amount in the range is more likely than any other amount in the range, the midpoint of the range is used to measure the liability. In GAAP, the minimum amount in the range is used. And then both IFRS and GAAP prohibit recognition of liabilities for future losses. However, IFRS permits recognition of a restructuring liability once a company has committed to a restructuring plan. GAAP has additional criteria. An example would be related to communicating the plan to employees before a restructuring liability can be established. And then there's some additional differences here. IFRS uses the term provisions to refer to estimated liabilities. Under IFRS, contingencies are not recorded, but are often disclosed. The accounting for provisions under IFRS and estimated liabilities under GAAP are very similar. And then GAAP uses the term contingency in a different way than IFRS. Contingent liabilities are not recognized in financials under IFRS, whereas under GAAP, a contingent liability is sometimes recognized. Well, that concludes Chapter 12. And Chapter 13 will be part of our next course, and I will have videos for those chapters as well in our intermediate accounting course number 2. Until that time, bye for now.